Hello, in this lecture we're going to talk about what a SEP IRA is and how it can be helpful to a small business. We will be able to define what a SEP IRA is, explain how it works, and list the pros and cons of the SEP IRA. As always, you want to seek tax advice from a professional when looking into retirement plans for the small business, including the SEP IRA. Okay, so we're going to start out with what is a SEP IRA. It's going to be a type of retirement plan for a small business. So the major goal of the retirement plan is to reduce the taxes in the year of contribution. So when we think about a retirement plan, we often think about a 401k plan for a business or an IRA, just an individual IRA for an individual. The reason we put the money in there isn't so much just to put it in savings for retirement, because we could put it into any account in order to save for retirement. The reason we put it into an IRA, which is restricted, is because we are incentivized to do so by the fact that we get to have a deduction or reduce our taxable income in the year of distribution. So that's what we want to do here. Now, the benefit of the SEP IRA or the 401k plan over just an individual IRA generally is basically that we can put more into it, and that's the major goal. So when we think about a small business putting the money into a retirement plan or setting up some type of retirement plan like a SEP IRA, usually the benefit will be that we're trying to increase the amount that can be put into the plan and therefore reduce the taxable income, reducing the taxes in the year it is put into the plan. You do want to remember that when you take the money out at retirement, it will then be taxable. And so what we've really done is just deferred the tax until retirement, which is usually a good thing. What are the advantages of the SEP IRA over other types of plans? When we think about a retirement plan for a business, we usually think of a 401k plan. A small business can set up a 401k plan, and it's good to take a look at the options of the 401k plan. The benefits being that the 401k plan is very flexible. The problems with the 401k plan are that there's more regulations to set it up, and there's more regulations to track it and do the reporting on it. The SEP IRA is set up for small businesses specifically to be a bit more simplified, so we don't have as much flexibility with it, but it's fairly simple to set up and the reporting requirements aren't as high. Higher contribution limits, so that's the major goal. What we're trying to do is say we want to have an IRA for the small business so the small business owner can put in more of the money into the retirement plan, and in so doing reducing the amount of taxable income in that year. We can do the same for the employees as well, allowing the higher contributions to the employees as well. We'll talk about that. Employer contribution only, resulting in more control. When we think about a 401k plan, we think about the idea that the employee is deciding how much to put into the plan, and we're taking that amount out of their W-2 wages and kind of reducing the amount of taxable wages on the W-2. Then the employer has the option of matching on top of that. With the SEP IRA, we're only talking about the employer deciding how much they want to put into the plan, and they're going to decide, the limitation being that what they put in has to kind of be standardized to qualified employees, which we'll talk about later, but it does give some control in terms of how much to put in, do they want to put anything in. So employer can change the contribution from year to year. This helps with planning, so we can actually kind of wait towards the end of the year and say, okay, let's do some tax planning. Do we want to put money in this year? Do we want to put more than last year? Do we want to not put any in at all? So that type of flexibility from year to year, big advantage for the SEP IRA. What is the process to set up a SEP IRA? To set up a SEP IRA, we're going to have to file a written agreement. Now, we could go to the IRS website and get a 5305, which we'll take a look at in a second. It's a pretty standardized type of form to set up. And then we could also go to the financial institution, like our bank or investment firm, and see if they could help us to set that up as well. Those are probably the two main options you want to take a look at. Talk to the bank, talk to your investment firm, see what they could do to help you set up the process. You could also have an individually designed SEP plan document, but you're probably thinking one of the first two most of the time. Provide each eligible employee with information about the SEP. Now, if we're a sole proprietor and we don't have any employees, or if we're a single member S corporation or something like that, then clearly the only reason we're setting up the SEP is so that we can increase the amount that we can put into the retirement plan, lowering our taxes. If we plan to have employees in the future, or if we have employees at this time, Then we have to ask ourselves, okay, what's going to be the cost for putting the money in for the employees as well, and we'll talk more about that in a second. Set up the SEP IRA for each eligible employee with a bank or other qualified financial institution. So if we do have qualified employees other than ourselves, then we're going to have to talk to our institution, our bank, or whoever's helping us to set this up, and set up their piece of the IRA plan so we can contribute for them as well. What does the Form 5305 SEP look like? So it's a pretty straightforward form. You can find it on the irs.gov here, and it's fairly simplistic type of form to set up when compared to, say, a 401k plan. How much can we contribute to the plan? All right, so we can contribute up to 25% of W-2 wages, capped at $53,000 in 2016. So if we're a small business that has a S corporation or a C corporation, or if we're an LLC that it's going to be taxed as a corporation, then we're generally going to have to pay ourselves a W-2 wage. And the W-2 wage that we pay ourselves, even if we're the owner, we can take up to 25% of the W-2 wages, and that's what we can basically put in to the retirement plan for ourselves. That would mean that we would need income of $212,000 in order to contribute. So that's going to be a pretty high W-2 in order to get to the max of the $53,000, but 25% is generally going to be often a lot higher than we could put into like a normal IRA. So those, how much we're going to get, how much wages we have is part of the calculation we're going to have to consider. Now, what if we're not an S corporation or an LLC that's incorporated? What if we are a sole proprietor? That means that we don't have a W-2 wage. We're just reporting the income on a Schedule C, basically an income statement, income minus expenses, that's just attached to the 1040. Now, because the calculation is a bit different, it's a little bit more complicated. You gotta go to the IRS website and look through a worksheet in order to get the exact calculation of what the max contribution would be. But it's around 20% of net income, meaning if you take your Schedule C income or your business income, your income minus your expenses, that would be your income and the taxable income, and that's what you would use to calculate. Now, it's not quite that way. It's because there's a few deductions related to the business on the 1040 that's not really on the Schedule C. So if you look at the worksheet that you can find on the IRS website, basically the calculation is going to take the net income on the Schedule C, make some adjustments for some other things, such as the fact that there's self-employment deduction, and then record the tax rate, the rate on that, to see how much can be put into the retirement account. So you can have your accountant help you out with that, but you can take a look at the worksheet in order to check out that calculation. Do we have to include employees, or can we set it up for the owner only? So again, if we're talking about a small business, oftentimes we might be talking about a business that doesn't have any employees, or we might have a business that has limited employees that don't work a whole lot in the business, or that are planning to have future employees. So what's the consequence of the employees? When we set up a retirement plan, there's generally going to be consequences in terms of the employees who qualify and our responsibilities under the plan for them. So we must include eligible employees, generally defined as 21. So we could set the restriction at 21 and say that if they're under 21, they would be, maybe possibly ineligible to participate, and we wouldn't be responsible to contribute in that case. Worked for the business 3 out of 5 years. So again, that's one of the restrictions that's possible to set in. If we didn't have any employees that worked more than 3 years, then we may not have to be responsible for contributing there. There's an income limitation, but it's fairly low, so most employees will be over that income limitation. How much would we have to contribute for the eligible employees? So it generally works that if the employees are eligible, they met those requirements, then whatever rate that we decide on for ourselves, we also basically have to apply that to the employees. That's going to be kind of the general rule on that. So if we maxed our W-2 wages at 25%, then all the eligible employees, we'd have to kind of figure that the same as well, 25% of their W-2 wages, not 25% of our W-2 wages, but that percentage of their W-2 wages would have to be the same. So that's why we'd have to do some planning from year to year. Now, it's possible from year to year that we can put money in one year and have a lower rate one year and a higher rate the other year. but we do have to consider that from year to year. When do we have to decide how much to put in? Not until the return is due, which can include extension. So this is a huge benefit to employees because it allows for tax planning. So what this means is, if you would think that you'd have to put the money in before the year end. So usually we have tax planning maybe in October, trying to think about some things we can do at the end of the year. It's the year ending in December. And for a normal IRA, you actually have till April 15th, if you're an individual IRA, the time you file in which to put the money into the IRA. This plan, you can actually put it on extension, which takes you all the way out to October and still kind of do some tax planning. So that gives a lot of leeway to kind of decide how much you want to put in, do the tax planning, what's the rate you can change from year to year, and figure that out all the way up through October following the close of the year on December in order to figure that out. So that's a pretty big benefit. What might we consider during the tax planning? So remember, if you're thinking tax planning in terms of how much should we put into the retirement account, first you kind of want to do tax planning in October if you can, because before the year ends, and think about how much income we want to make, and is there any way that if we can defer income within this year or not, or get any more expenses before the close of the year. Then once the year closes, we can figure out what the net income is, and then figure out what would be the maximum percent that could be put into a retirement plan. We'd also want to figure out, are there any eligible employees at that time? Who is eligible? Who are we responsible for in order to put a matching amount in their retirement? And then we kind of want to look at the tax rates, obviously, and say, all right, if we put the money in, what are they going to be the tax savings? And that depends on our tax brackets. And we want to compare these tax brackets to possibly where we would be at retirement because we're deferring the income. And those are just some of the things that we would want to consider when thinking about the planning process. How do we report this income if the IRS contribution is made after the year end? So you might be asking, just logistically, how does this work? I mean, how is it possible that the year end closes in December, we're reporting income and expenses for the year end in December, and we're not doing this until next year? We're not making the actual deposit. So how is it we're getting the deduction as of the year end in December when we're making the deposit after that? So for our books, it's not going to be too tough to do it on our taxes, because what we'll do is we'll just do an adjusting entry. We'll include the expense on the return when we file the return as of December 31st, because we're not filing the return until a later time. So just on a bookkeeping side, that would be a debit to the expense for the employee benefits and a credit to the liability, SEP liability account. Basically, we're just putting the expense, the deduction on the books when we file the return. On the employee side, if we have employees, we do have to report this to the employees, kind of like we would report W-2 or 1099 income, and we would do that using a Form 5498. Now, we can report the Form 5498 in the year that we actually made the payment rather than the year we're reporting the income. And on the IRS's side, unlike the 1099 income for a lot of different, or W-2 income, this income is money that we gave to the employee, but it's not taxable, so it's not going to be a taxable effect on their income statement because it's going into the retirement plan. So they're not going to need this form in order to basically fill out their income as of the end of the current year that we're taking the expense in, and we can file the form for them in the following year. So that form looks like this. This is the Form 5498, basically reporting the contributions made.